Okay, so imagine you lend your friend $20. He cannot pay you back. Annoying, but fine. You lose $20. Now imagine you lend that same $20 to a million people. And none of them can pay you back. And you borrowed that money in the first place. From someone else. Who also borrowed it. That is basically 2008. Except the numbers had a lot more zeros. Let me explain exactly what happened. And I promise by the end of this, you will never look at a bank the same way again. It starts in the early 2000s. America is not having a great time. The dot-com bubble just exploded. Millions of people lost money on internet companies that had never made a single dollar of profit. Then September 11th happened. The economy was rattled. People were nervous. So the Federal Reserve did what governments do when they are nervous. They made borrowing money extremely cheap. Interest rates dropped to historic lows. And suddenly, everyone wanted to buy a house. Which makes sense, right? Money is cheap, houses are solid. You can see them, touch them, live in them. Unlike those dot-com companies that turned out to be a website and a dream. So far so normal. Here is where it gets interesting. Banks started giving mortgages to basically anyone who asked. And I do not mean anyone with a decent job and a savings account. I mean anyone. People with no income. People with no job. People with no assets. No credit history. No problem. There was actually a name for these loans. They were called ninja loans. No income, no job, no assets. Someone, somewhere, sat in a meeting and thought ninja was a good name for a financial product. And everyone else in that meeting nodded and said yes. That is a professional environment. These were called subprime mortgages. Sub meaning below the standard. Prime meaning the actual qualifying standard. So subprime literally means we know you probably cannot afford this, but here is the money anyway. Why would a bank do this? Why would any sensible institution lend money to people who clearly cannot repay it? Because they had a plan. And the plan was genius. Right up until the moment it was catastrophic. Here is the plan. The bank gives you a mortgage. But instead of waiting 30 years to collect your repayments, the bank immediately sells your mortgage to someone on Wall Street. Wall Street bundles your mortgage together with thousands of other mortgages and sells the whole bundle to investors as a financial product called a mortgage-backed security. Investors love it. It pays regular returns. It is backed by houses, physical real things. What could go wrong? The beautiful part from the bank's perspective is that the moment they sell your mortgage, it is no longer their problem. You default tomorrow? Not their issue. They already got paid. They are already writing the next mortgage. So the bank's job is no longer to give good mortgages. Their job is to give as many mortgages as humanly possible and sell them as fast as possible. Quality? Irrelevant. Speed? Everything. It is like a chef who gets paid per plate regardless of whether the food is edible. You would also be cooking very fast and very carelessly. Now here is the part where everyone collectively loses their mind. By 2005, buying a house is not about having a home anymore. It is about flipping it. Buy a house today. Sell it in 6 months for double the price. Buy 2 more. Sell those. Retire at 42. Simple. People who had never invested in anything in their lives were buying 3 properties simultaneously with borrowed money. A school teacher by day, a property investor by night. A barista with a mortgage on a Miami condo she had never visited. And the reason everyone felt comfortable doing this was one shared belief so powerful it felt like gravity. House prices always go up. Not sometimes, not usually, always. It had been true for decades, therefore it would always be true. Forever. Obviously, this is what psychologists call recency bias. You take recent history and assume it will continue indefinitely. It feels like logic. It is actually just pattern recognition running too confidently. Everyone was running the same bias. On the same asset. With borrowed money they could not afford to lose. Meanwhile on Wall Street, things are getting creative. Those mortgage bundles are being sliced and repackaged and combined and repackaged again into increasingly complicated financial products with increasingly confusing names. Collateralized debt obligations, credit default swaps, synthetic CDOs. Nobody fully understood what these things contained. That was almost the point. The complexity made them hard to question, and the ratings agencies whose entire job was to tell investors how safe these products were, gave most of them the highest possible safety rating, AAA. As safe as government bonds. Some of these AAA-rated products contain mortgages from people with no income, no job, and no assets. The ratings agencies were being paid by the banks they were rating. which is a bit like hiring a referee and paying his salary yourself. You would probably get favorable calls. In 2006, house prices started falling. Slowly at first, then very quickly. The people who had taken mortgages they could not afford started missing payments, then defaulting entirely, then walking away from houses worth less than what they owed. The mortgage bundles that Wall Street had been selling started losing value. The investors who owned them panicked. They tried to sell, but everyone tried to sell at the same time. When everyone sells simultaneously, prices do not fall gradually, they collapse. Banks that had loaded up on these products suddenly discovered their balance sheets were full of things worth almost nothing. Banks that had borrowed enormous amounts of money to buy even more of these products discovered they owed more than everything they owned combined. In September 2008, Lehman Brothers, 158 years old, one of the biggest investment banks on the planet, filed for bankruptcy. In one day. The moment Lehman fell, every bank in the world looked at every other bank and asked the same question. Are you next? And because nobody trusted anybody's answer anymore, banks stopped lending to each other entirely. The credit system froze solid. Now here is why that matters to a normal person who has nothing to do with Wall Street. Businesses borrow money constantly. Not because they are struggling, because that is how business works. You borrow to buy stock, pay employees, cover gaps between invoicing and payment. When the credit system froze, businesses could not borrow. So they could not operate. So they started laying people off. Unemployment spiked. People with less money spent less money. Businesses lost revenue. More layoffs, less spending, more closures. The feedback loop accelerated faster than anyone could stop it. In 6 months, 8 million Americans lost their jobs. 6 million lost their homes. Trillions of dollars of wealth that people had spent decades accumulating simply vanished. Not stolen, not moved somewhere else. Just gone. The government stepped in with a $700 billion bailout called TARP, Troubled Asset Relief Program. Basically taxpayer money used to stop the banks from collapsing completely. The banks that caused the crisis got rescued. The people who lost their jobs and homes did not. No major Wall Street executive went to jail. Most collected their bonuses and retired quietly. The people who saw it coming and bet against the system made billions. The people who trusted the system lost everything. So why does any of this matter to you right now in your life today? Because none of the psychological patterns that caused 2008 have disappeared. The overconfidence is still there. The herd behavior is still there. The shared delusions about which assets always go up are still there. Every financial crisis in history follows the same pattern. A new opportunity emerges. Early people make extraordinary returns. Others feel left out and join in. Prices detach from reality. Confidence cracks. Everyone tries to exit at the same time. The collapse is faster and deeper than anyone predicted. Tulips in 1637. Railroad stocks in the 1840s. Internet companies in 2000. Housing in 2008. Crypto in multiple cycles since. Different asset. Identical human psychology. Every single time. The next crisis will not look like 2008. It will look like something new and exciting and obviously safe. Until it is not. The best protection is not predicting which asset will collapse. It is understanding that you are not immune to the same psychological patterns that convinced millions of intelligent people that house prices only go up. Because they were not stupid. They were human. And so are you.